Every Monday to Friday, this is Peter Lewis's Money Talk.
Money Talk.
Good morning, this is Peter Lewis. A warm welcome to Money Talk for Wednesday the 10th of July. It's a new business day and I have an update on the top business and finance stories for you. And this podcast is sponsored by Surfing Group, which is headquartered in Singapore and offers online financial services to 50 million customers across 10 countries. In today's business and finance headlines, Federal Reserve Chairman Jerome Powell acknowledged Tuesday progress in tackling inflation, but he didn't give a clear signal that the US central bank is close to cutting interest rates. However, he did express concern that holding interest rates too high for too long could jeopardise economic growth. Mr. Powell said that inflation remains above the US Federal Reserve's 2% target, but has been improving in recent months, and more good data would strengthen the case for interest rate cuts. International investors will be able to pledge their holdings of Chinese domestic bonds as margin collateral for northbound Swap Connect trading later this year, authorities said Tuesday. The move aims to reduce the cost for overseas investors to trade mainland bonds. Eddie Yu, the CEO of the HKMA, said the usage of onshore bonds as collateral for Swap Connect will expand onshore yuan bonds applications and benefit the internationalization of the yuan. NATO leaders gathered yesterday in Washington for a three-day summit aimed at showing resolve against Russia and support for Ukraine, but the meeting is set to be overshadowed by President Joe Biden's fight for political survival. The 81-year-old leader will try to use the summit, marking NATO's 75th anniversary, to reassure allies over US leadership and his own ability to govern, as calls grow for him to quit the fight for a second term in office. Asia-Pacific stock markets rose Tuesday, led by stocks with exposure to artificial intelligence. Japanese stock indices hit record highs. The Nikkei 225 rose 2% to hit a new peak at 41,580, while the broad-based topics added 1% to hit new highs, as the share price of companies with AI exposure rose. Semiconductor precision toolmaker Disco, robotics group Kaonce, and chipmaker Tokyo Electron drove the gains. On today's programme, I'm joined by Enzio von Pfeil, Capital Preservation Specialist at Financial Shield, and Tim Huxley, Chairman of Mandarin Shipping, and with a view from Japan is John Beirne, who's Principal Economist at the Asian Development Bank. And if you want to get in touch or take a look at the Asian Daily Newsletter, please go to my website, peterlewismoneytalk.substack.com.
Peter Lewis's Money Talk.
US stocks made little progress on Tuesday after Fed Chair Jerome Powell said the central bank had made considerable progress in its fight against inflation, but was awaiting more data before cutting interest rates. Wall Street's S&P 500 gauge and the tech-heavy Nasdaq Composite were both around 0.1% higher at the close in New York. Those small gains helped the indices to close at records, with the Nasdaq crossing 18,500 points for the first time intraday. The Nasdaq ended the day up 0.1% at 18,429. The S&P 500 ended the day less than 0.1% higher at 5,579. The Dow fell 53 points, or 0.1%, to 39,292. The 10-year Treasury yield edged up 3 basis points to 4.3%, and the 2-year yield was 1 basis point higher at 4.62%. And the next significant data point will be the US Consumer Price Index on Thursday and producer prices on Friday. The dollar gained on Tuesday after Jerome Powell didn't give a clear signal that the US central bank is close to cutting interest rates. The US dollar index was up 0.1%. The dollar was 1/3% firmer against the yen at 161.26 yen per dollar, and the offshore yuan edged lower to around 7.29 renminbi per dollar, following a weaker guidance rate set by the People's Bank of China. Spot gold settled 0.2% higher at $2,364 an ounce, and Brent crude oil prices fell 1.3% on Tuesday to $84.66 a barrel in the third straight day of declines. Bitcoin prices stabilised after their recent rout. The cryptocurrency climbed back above $57,000, adding 2.4% to $57,735. And Chinese stocks recovered from recent declines on Tuesday. The Shanghai Composite jumped 1.3% to close at 2,959, reversing losses from earlier in the session and rebounding from 5-month lows. And the Hong Kong's Hang Seng Index was unchanged at 17,500 623. Futures markets pointing to a gain in the Hang Seng of about 35 points at the open this morning. And you can get more details on the latest market movements in my daily newsletter, which you'll find at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
It's Wednesday morning. Welcome back to our capital preservation specialist at Financial Shield, Enzio von Pfeil, and our regular Wednesday commentator. Morning, Enzio.
Good morning, Peter.
And also with us is Tim Huxley, who is the chairman of Mandarin Shipping. Welcome back, Tim.
Hello, Peter.
It's going to be a busy week for economic data from China. We've got the CPI and the PPI data later today. And then tomorrow we've got crucial loan data, including total social financing, new yuan loans and outstanding loan growth. The amount of loans slowed very sharply in May, and the head of the PBOC has warned markets to expect lower loan growth going forward. Pan Gongshen said last month it's natural that the growth rate of credit has declined alongside a shift from high speed to high quality developments, and he said many loans in China are not efficient. And then we have trade data on Friday. Both exports and imports came in below expectations in May. And then a big day on Monday. China releases its GDP growth rate along with economic activity for June. And of course, the third plenum starts on Monday. So let's talk a bit about the third plenum. I mean, Enzio, perhaps you can kick off by just explaining to listeners what the third plenum is.
The third plenum, it's the meeting of the party's central committee. And in it, the central committee sets out a roadmap for economic policies in the coming 5-year cycle. So that's what this plenum is about. It goes from this Monday to this Thursday. So it's a very important sitting of the party central committee to outline policy roadmaps for the next 5 years.
And according to your economic clock, what is the current state of the mainland economy?
It's clearly stuck in a structural slump which goes way beyond the clock's cyclical time-telling. In a cyclical sense, it's very much an excess supply of money, but also a very, very pronounced excess supply of goods. But in this case, I think China, by perhaps making life very difficult for the private sector, has pretty much thwarted consumer confidence, and that transcends any cyclical ups and downs and is really leading, I'm afraid, to a Japanese-style deflation in China.
So when the third plenum hopefully makes some decisions about its economic strategy for the next 5 years, what do you think are the key things, the key challenges it's got to deal with in whatever it decides to do?
Well, the first one very clearly is to get the companies to want to invest again, because that's the key. The private sector really drives employment, drives bank lending, and until the private sector is really allowed free rein yet again, once the government drops its ambivalence, outright hostility towards successful entrepreneurs, for instance, then once it's dropped that ambivalence, then I think you'll find things going again. But whether that's going to be politically possible is very difficult, particularly for me as a non-Mandarin speaker, to really gauge. My gut feel is that it's going to be very difficult to usurp this kind of anti-business, anti-private sector view. Also, the government business models need updating. At present, it's the local governments that are under duress, so they need to be they need to stop just selling property, and the government gets taxes. So I think the overall problem with China is a much deeper one that transcends this policy headwind and the center versus the provinces, which is just that it's whether the center really wants to divest and disperse more power to the provinces themselves. So those are three big issues that go way beyond just what it's going to tinker with in the economics of today.
Okay, well, let's bring Tim in. Tim, you have a big business on the mainland. First of all, are you sort of predisposed to sort of increase investment on the mainland at the moment?
I think everybody's quite cautious at the moment. It's it's been a very difficult environment. And I know the third plenum, yes, obviously very important, but I think maybe this view of looking at things in 5-year cycles is, or setting plans for 5 years, is maybe slightly out of date. I mean, let's just look back at 5 years ago, 2019. Well, that was pre-COVID, pre-Ukraine war, when the world can change an awful lot in 5 years. I mean, these events obviously have huge implications on China over the years. We look back in 1978 when Deng Xiaoping announced the sort of opening up of China. We had a revision to the one-child policy that was announced. So I'm not actually expecting anything massive, structural changes that are really going to grab headlines around the world. If there can be some the structural reforms that will that we are expecting in the private sector, that will obviously help. But I've got a horrible feeling that the headlines will be grabbed by the sort of things like the endorsement of the dismissal of the defense chiefs and various other things that are expected during this. But at the end of the day, as any of us who have been here for any length of time know, you can never underestimate what is happening in China. And if you actually look at it, I mean, there is actually quite a few positive things about China, but it's all down to the fact that you can't, comparing it to the chaos that seems to be going on in much of the rest of the world. I think there'll be quite a lot of focus on AI and the development of that and China's potential there. In terms of the traditional manufacturing industries and China's exports, I don't think, I'm not expecting any sort of massive changes. And we are really reliant on, continued pickup in demand in the rest of the world. And these continued battles with tariffs and all of the sort of rhetoric that is going on. If there's anything that came out of it, I'd just like to see something that calms down the rhetoric that is going on around the world in China. You can't look at China in isolation on this. We've got all these elections coming up. Let's just sort of try and just temper everything down. Just look at what we're trying to achieve in the bigger picture. Like, let's get a resolution to these various conflicts that are going on in the world. And let's get the world actually back to sort of normalize the trading relationships that we all have.
Do you agree with Enzio that at the moment the environment on the mainland is not very favourable to entrepreneurs and it doesn't really encourage them to take risk because, when you take big risk, you want to get big rewards. But at the moment, the Chinese leadership doesn't really like people getting big rewards at the moment. Do you feel that that's the case?
I still think that there are enormous opportunities there, and you've got to sort of try and isolate them within particular sectors. I mean, you look at what's happening in just over the border from Hong Kong in the Greater Bay Area. I mean, people are seeing great opportunities there, but overall, one would say that, and it's not just in China. I mean, I think people are actually being quite reticent about big investments in many sectors, and you're seeing people restructuring the way they're going about their manufacturing and where they're investing. Obviously, AI is the hot topic at the moment. Now then, I've got a feeling that an awful lot of what will be discussed in not just in China, but at other forums around the world over the next few weeks is going to be about the regulation and the downside of of what is coming along with AI and vast opportunities, but also a lot of potential issues there.
If there's one thing you'd like to see most of all out of the third plenum, one big initiative that you think could make a difference, what would you like to see?
Well, I'd like to see an easing of the contradiction that there needs to be more help for the private sector. To be more help for the private sector, more support, but at the same time that they should be sort of cut free. I think the world is sort of too much of a crossroads, slightly too much confusion for any big announcements. And I'm not expecting anything massive this time, but it will be sort of steady as she goes. There are still some very positive things coming out of China. I mean, there is investment still in China. I mean, we had yesterday, you just look at a traditional heavy industry that you'd think would be sort of pushed to the side with all the AI talk and everything, which is shipbuilding. I mean, in Dalian, I mean, one shipyard there, they're going to invest $1.3 billion US in expanding production at a yard that went bankrupt a few years ago. So, there are still some positive stories there. We seem to be obsessed, and when you talk to anybody overseas, it's always about the decline in the Chinese property sector. Are we going to move on from that being the dominant theme? I mean, that's going to be the issues in Chinese property. I think they're going to continue to haunt the whole Chinese economy for some time to come. But there are other positive things, and that's why I think the focus will probably be on new technologies. When you look at what's happened in the last couple of years, areas like the motor industry, China has come to be the dominant player in it, with all of the issues that produces. So are we going to have something moving on here rather than being stuck in sort of trying to dig our way out of the particular holes like property that we've been talking about for so long? I mean, there's a lot of new developments. So I'm still actually quite positive longer term. But, we've got a lot of hiccups to get over. How they will manage to get through that, it will be very difficult, that's for sure. And we just have to hope that the optimism and entrepreneurial flair. I mean, let's just look back 20 years ago when it was all absolute gangbusters up in China. I mean, I don't think that's going to come back to the same extent, but there is still a lot of potential and a lot of opportunity there.
Enzio, how do you feel going forward? Are you as optimistic as Tim about the potential for the Chinese economy?
I think at the end of the day, yes. But as Tim was saying, it's more of a gradual upward slope as opposed to an alpine mountain that's just going to sort of, the sky is the limit. I think that's kind of my view. The emphasis in order to maintain social stability has got to be job creation. I'm afraid that's only going to really come through the private sector. So I keep on harping on about this. I have for the past year that really needs to be nurtured perhaps a bit more in China.
So this is in order. This is where the economic model overall is not going to change, is it? It's a model whereby the centre, i.e. Beijing, picks sectors that it wants to invest in. Yeah. Albeit those sectors change over time. Right now it's, new energy sectors, electric vehicles, batteries, plows a lot of resources into that, often at the expense of other sectors. And right now those are manufacturing, capital intensive sectors, so not so good at creating employment. But this model isn't really going to change, is it?
No, that's the communist ideology. I learned this quite in depth when I was doing my German A-levels, the Abitur, back in the 70s. It dates me wonderfully. And it's the same problem that Russia's had, and what my professor von Hayek always taught all of us, and that was his whole mission, was that no individual can gauge and guess what the market wants. That's what the private sector is about. That's why the private sector invests abroad, to keep its ear to the ground, to see where the demand is changing. No bureaucrat sitting in a little office somewhere with no business experience anywhere in the world can figure this one out. And so I'm afraid that's ideology. It has to go back to what Deng Xiaoping was doing, which was just fabulous, I thought, of getting of embracing the private sector and seeing how to harness the private sector within the party's objectives. Why not?
Tim, is it going to be too much to hope for that we will have a more market-orientated economic model? It's often talked about, often promised, in fact. But, if things like electric vehicles, batteries are such a good thing, the market will find out for itself and businesses will gravitate to that area and they will invest money themselves. They don't need to be told to do it or have huge subsidies to do it.
Yes, I mean, you're right, Peter. I mean, business will gravitate to what is good for business. You will have the structural necessities like energy sector and agriculture and everything, where there will always be some state control and industries of strategic importance. But I think that if we these new industries like AI and electric vehicles and energy, etc. I mean, sure, it's fantastic that the Chinese government will help jumpstart those to really sort of get them going, and China gets an advantage in it. And if you look at, say, renewable energy, I mean, China is absolutely leading the world in how quickly it's rolling out renewables. I mean, yes, sure, it's still building coal-fired power stations. Yes, sure, it's a big polluter, but it's a massive population. It's a massive economy. I mean, places like the UK, they go to net zero. That makes no difference whatsoever. China continues its rollout of renewables. That's going to have an impact. So, and there they are actually establishing a world-leading position. And that's with a bit of help from central government to start with. But you're right. I mean, then if that is a viable business and everything, it will then attract private investment from both within and outside of China.
And it doesn't need government subsidies. If electric vehicles are so good and Chinese companies are so far ahead, they won't actually need any subsidies.
That's true. Yes. I mean, and which is a great thing. So as I say, I think jump-starting these particular sectors, there's nothing wrong with that, and a bit of nurturing of new industries. But if they're given the opportunity, and if the product is good enough, and if you look at electric cars and everything, yes, Chinese electric cars are now world leaders, then everything else will follow, and you will not need the subsidies. I mean, we're all against subsidies and tariffs and everything. Anybody listening to this program is a free trader by nature, I reckon. So I think that will filter through the whole system as these industries develop.
Enzio, there's another problem that needs to be fixed, isn't there? Which is really the whole funding model for the local governments, because it's local governments that have to do the spending, and there's more pressure on them now to go and buy up unused properties as well, aren't they, to convert them into social housing. But it's Beijing that collects all the taxes, and this model is increasingly broken as well.
Yeah, I think it begs the much larger question, which again I learned back in Germany, which is this fight between the center and the between the spokes and the hubs. And I think that just like Hong Kong is also having to learn to wean itself off the land model, sell land and make money and then fill the coffers. I think that China is going through exactly the same issue. It sounds to me like taxes will be on the way, perhaps consumption taxes, which are, of course, regressive. They kind of go against the idea of equality in any part of the world. There's nothing Chinese about this. But yes, I think that business model is needing to be changed rapidamente, basically.
And a consumption tax is going to be very difficult, isn't it, at the moment when consumer spending is so depressed?
Yes. So there's I mean, I don't envy the Beijing government because it's in for quite a tough period now to just get growth and consumer confidence back on its feet. I think they will prevail because the Chinese are known to be quite realistic people, but it's not going to happen tomorrow morning.
Okay. Tim, you mentioned earlier that you'd like to see an end to some of these geopolitical conflicts that are embroiling us and embroiling China at the moment. There's trade tariffs, aren't there? Sanctions on certain types of exports. We've got wars going on as well. We've had some changes of government in Europe, in the UK, and in France as well. We've got a hung parliament now. Is this going to make things better or worse?
Well, of course, the great thing for China is they don't have to worry about that. So that allows them to do a bit more long-term planning. Will the change in government in the UK make any big difference? Probably not. I mean, well, you might have a few more people moving out here if there is a massive hike in taxes or whatever. In France, they have a very pivotal role in the EU, and that things could change there. But I mean, I have to be honest. You're watching these elections and the results coming in, and you always wonder if there's in Russia, Beijing, and maybe one or two other places, they're all on a sort of conference call together saying, hey, guys, are you seeing this? Because, I mean, it really has been crazy, hasn't it? I mean, you've got to remember, I mean, UK government, that changed. But the Labour Party in the UK got 2% more votes than Jeremy Corbyn got when he tried to run to be Prime Minister. So I think the big election, obviously, is the one we've got coming in November in the States. Hopefully, things will settle down. But these are, in the grander scheme of things, I mean, China is, from an economic point of view, where things stand there, that is much more significant than what's been going on in the UK and in France.
Mm-hmm. Enzio, let me get your thoughts on the Fed. Jerome Powell gave his testimony to the Senate Finance Committee yesterday. He seems to be trying to balance two things at the moment, doesn't he? One is the fact that inflation is still above target, but the other thing is that growth now is clearly slowing, isn't it? We're seeing that in many places. We're seeing it in the ISM services number. We're seeing it in the jobs data. How does he balance this?
Well, this is very good. This is, Peter, a very good question. I think Mohammed El-Arian in the FT always produces some pretty brilliant stuff. And he was, this week, in his opinion piece, was scathing about in my diction at least, the Fed's arrogance, perhaps, in not really looking at the market as much as it might, and thus it's had all these policy pivots. That's not for me to judge the Fed. I've never been close to it. But I do think that the framework has been a little bit outdated. It's not just demand-driven inflation, it's also supply-driven inflation. Supply shocks also need to be engaged with and looked at. It's a little bit like what my wife tells me, to go to doctors, not the ones that are so old that they're actually very ensconced in their ways, but to also get younger blood, to go and see younger people who've just come out of university, who've had 5 years experience, because they're far more up to date with current events, what's going on in the medical or indeed in the economics field. So my basic thesis there is that if the Fed needs to rethink its whole business model and veer away just from this kind of ideological demand-driven, too much money is chasing too few goods, as if you can fight agricultural food price inflation by tightening the money supply. I mean, the corn stock most certainly doesn't know that, nor do the sunflowers, nor do the plantations of Malaysia.
Mm-hmm. Tim, I suppose it's fair to say, isn't it, that here in Hong Kong and on the mainland as well, businesses really want to see some rate cuts, but they may have to be patient for a while longer yet.
Yeah, I'm sure that would stimulate investment if borrowing costs are lower, and if the banks are actually more willing to look at some of the opportunities that are out there. I mean, it's been a really challenging time for both individual companies and indeed for banks. I mean, and you've got to sort of separate out different industries. I mean, it's been fascinating being in the shipping industry during this period, because shipping industry made a huge amount of money during the pandemic period. And as a result, it's been an incredibly competitive market for banks trying to actually lend money, because the ship owners don't need it. And so as a result, a lot of banks are pulling back on that. So I'm worried that there will actually be, once we actually do interest rates reduced, it's such a competitive environment that a lot of people might actually sort of pull out of it. And then it will be more difficult to raise funding. But at the moment, I mean, lower borrowing costs will stimulate growth. That's a fact.
Okay. Well, thank you both very much and have a great day. That's Tim Huxley, who is the chairman of Mandarin Shipping, and also Enzio von Pfeil, who is capital preservation specialist at Financial Shield.
Peter Lewis's Money Talk.
I'm joined now by John Beirne, who is the principal economist at the Asian Development Bank. Morning, John.
Good morning, Peter. How are you?
I'm very well, thank you. Now, we had some data out of Japan this week that's quite interesting. Real wages for Japanese households fell for a 26th consecutive month in May. Average cash earnings in Japan, they did increase by 1.9%. However, if you take into account inflation, then the nominal wage growth lags behind the 2.5% core consumer inflation rate. So it means that in effect, households are losing money. They're getting negative inflation adjusted real wages. They fell 1.4%. I suppose, John, this really sums up right now the problems for Japan and the Bank of Japan, doesn't it? In just trying to get households and the consumer to feel better and to actually be making more money at the end of the day.
Yes, that's right, Peter. I think recent data coming out of Japan is not very positive in terms of what it means for the economy. We saw, as well as that, in the first quarter, a contraction in GDP related to the developments in the automotive sector, which we hope would be something that is temporary and the economy can bounce back from that. But as you said, real wages continue to be the key issue in terms of affecting domestic demand, affecting private consumption, even affecting the corporate side in terms of investment as well, because there will be spillovers to that part of demand as well. And it really poses problems for the Bank of Japan, as you said. It is, of course, wishing to stimulate some sort of sustainable inflation over the medium term. Inflation now is running at a round target, but of course, the yen is significantly depreciating and has been doing that for quite some time now. And this is problematic in terms of what it means for the purchasing power of income and what it means for essentially wages and whether consumption can really pick up as a result of what we might see developing on wages.
We had the Japanese Trade Union Confederation saying on Wednesday that the average wage hikes in the spring wage negotiations was 5.1%. That's a big hike, isn't it? So when are people likely to start feeling the benefit of that?
Yes, so the wage negotiated amount was very high, the highest level in 33 years, I think. But, you know, this is a negotiated nominal wage rise for large firms. Now, the issue is whether small and medium-sized enterprises would be able to provide nominal wage rises at that level. And this is really the main issue in terms of the broader economy. SMEs account for the bulk of the labor force, 70% around. So unless they would be able to offer nominal wage rises that would outstrip inflation, then overall we would not see this real wage growth slipping into positive territory. So it's really the problem that the negotiated wages are confined to the large firms.
So what's got to happen? How do you get this virtuous circle that the Bank of Japan keeps talking about and hoping for of higher wages and then, of course, in higher inflation, but not such high inflation that it wipes out the impact of those wage rises?
Yeah, it's a very delicate balancing act at the moment, given the outlook for growth. I think one of the key concerns, of course, is what will happen with the U.S. economy and the trajectory of U.S. monetary policy in particular. You know, we're in a higher for longer scenario now as regards the interest rate environment in the U.S. And this is something that is leading to some sustained widening of spreads between the US and Japan and essentially piling pressure on the yen. And this is really one of the factors which is contributing to inflation in Japan and therefore affecting real wages. So if we would see some appreciating pressure or at least some moves towards a narrowing in interest rate spreads between the US and Japan, it could be helpful. I think it's difficult to know what can take place at the domestic level. One of the positives, of course, is that exports have increased, but on the domestic demand side, it remains very fragile at the moment. given, as we discussed the real wage scenario and the pressure that inflation is having on households and firms.
Is there anything that the government can do to address price increases, or is what's going on really all out of their control?
Well, the government, it has been offering some respites to households in terms of subsidies. And this helps with elevated energy prices that have materialized in the recent years. And there are various measures introduced to deal with that. But I think, these types of measures are not really a long-term solution. They would be targeted, temporary, and ultimately they should be regarded as a bridge towards a longer-term solution, which would be to somehow kickstart the economy and to encourage small and medium-sized enterprises to offer wage increases that would match inflation. And the problem there is that, historically there has been a reluctance of firms more broadly to pass on price increases to consumers in order to maintain market share, for example. This has changed somewhat in the recent years. There is a passing through of prices that are coming from abroad, cost push pressures that are being passed through to consumers at the moment. And we are seeing this taking place. But of course, whether it would trigger increases in wages is something that's very much more uncertain. And also the economic outlook for the economy is something that firms also take into account when they're thinking about wage changes or potential wage changes.
And you mentioned the yen. In the meantime, the yen is still sliding. It's below 161 at the moment. Really, no sign of it sort of strengthening. Maybe even if it stabilises around current levels, it doesn't seem to want to strengthen at the moment. I suppose part of the problem of this is that we had a long period, didn't we, of this sort of almost extreme monetary policy experiment at the Bank of Japan when Haruhiko Kuroda was the governor, and they openly espoused a weak yen. And I suppose we're now paying the price for that.
Yes, that's a very good point. I think, one issue is that we've been talking for some time about the level of the yen and its depreciating trajectory being driven by interest rate differentials relative to the US. But, the yen has continued to slide significantly if we even take since the last 12-month period. So I don't think it's clear that we can ascribe all of this depreciating trajectory to fundamentals. So it cannot be all related to the spread. Otherwise, what we said last year would imply that, well, the fundamentals are not quite right. So I think there's something happening beyond fundamentals that is driving the yen. In other words, even if we would see a narrowing in the spread, we're not likely to return to 110 levels that we had seen a couple of years ago. So I think that there may be a case to say that perhaps there was some overvaluation of the yen in previous years that is now somehow unwinding. But I think certainly it's a significant policy challenge for the Bank of Japan at the moment.
I remember the days back in the 1980s, 1990s when the Bank of Japan and the government openly wanted a strong yen. They actually said that was good for the economy, good for the country. A strong yen was one of the pillars, if you like, of its economic policy. But we've sort of moved away from those days, I know. But maybe there needs to be a sort of a change in psychology, doesn't there? That a strong yen is good, can be good for the economy. And the Bank of Japan, once it starts getting on with it and raising interest rates and saying that, would that help?
Yes, I think it certainly would be a move in the right direction. It would certainly help with consumer sentiment. It would also contribute potentially to an upward shift in domestic demand as a result of that, if we would see, for example, some movement on the real wages front. But I think, essentially, we are moving into a very weak territory in terms of the level of the yen, and it's difficult to pull any positives out of that. It's inflationary. It's affecting household demand as a result of that. It's there is one positive you could say that, or a couple of positives would be, for example, tourism has come in sharply. So there is a net export services sector effect. There's also export growth on the goods side as well, particularly in some key sectors. But overall, I think the level of the yen is problematic at the moment, and we are not seeing this transmission of currency weakness to growth. So we're not seeing the pickup in external demand that we might expect to see from such a extent of currency depreciation, and this is really due to a lot of production and manufacturing activity in Japan, which is shipped essentially offshore in many cases, and therefore avoiding or bypassing the exchange rate effect in this regard.
And has there been any progress on the Bank of Japan's pledge to start reducing its bond purchases? It was talking about it, wasn't it, at the last meeting, but wasn't ready to announce the plans. Have there been any developments?
Yeah, I think we will know more about that in the next couple of weeks. Slowing the purchasing of bonds is something that is mooted, and this is a move towards tightening. So I think we can see this clearly coming out if we look at, for example, the bond yields, which are above 1%. And again, if we look at the spread in the bond yields relative to the US, we're actually in a narrowing territory, and yet we still don't see any strengthening in the yen. So I think we can expect further communication on that at the next meeting, which takes place at the end of this month.
Now, meantime, on the other side of the equation, in the US, Jerome Powell was speaking yesterday in his testimony to the Senate Finance Committee. It looks like he's trying to balance a couple of things, isn't he? He's not satisfied yet that inflation has been vanquished, but at the same time, he's starting to recognise that if he waits too long, it's going to hit growth. In fact, the data is already suggesting that growth is now slowing in the US. He's got a bit of a tricky balancing act to do as well, hasn't he?
Yeah, that's right. That was one of the key outcomes in what Chair Powell was saying at the Senate. So there's a clear balancing act to take in terms of supporting or not triggering a recession, essentially, but also not inflaming inflation at the same time. So I think overall there was no clear direction in the statement. I think we can expect a higher for longer scenario. We will not be moving into a tightening scenario. I think that's quite clear. But in other words, we would need to see some clear movement on inflation, however, before we would see some easing to take place.
I mean, although he acknowledged that, there are risks of waiting too long, at the end of the day, he still didn't give any indication that he's ready to start cutting interest rates or say when he would be ready.
That's right. I think this is in line with what has been the statements coming out of the Fed for some time. So there's no commitment, of course. The Fed is highly data dependent, as we know. And actually, this may have contributed to some volatility because, markets understand that the Fed is reacting to data in a manner which can trigger changes in policy that might be not fully expected. At the moment, we are seeing some softening in the labor market, which would, point towards the case for easing. We are seeing inflation coming down or, certainly moderating somewhat, which also points towards the case for easing. At the same time, it will take more convincing evidence for the Fed to make that change. We were expecting the first cut in June. It hasn't happened. Markets are talking about 1 to possibly 2 or even none in terms of rate cuts this year. It really depends on what comes out of the data in the next weeks and months.
Well, we got inflation data coming out this week from the US, the CPI and the PPI numbers at the end of the week. But do you think the Fed is running out of time? Because it can't just turn up in September and cut rates, can it? If it's going to do that, it really needs a bit of time to prepare the ground. That's the way the Fed normally operates. You suddenly start getting signals from FOMC members that they're ready. Rate cuts are coming. It's going to take a couple of months to do that. So if they want to cut in September, they've really got to get on with preparing that ground, haven't they?
Well, I think that's not so much of a problem. I think markets understand that there is an easing bias as opposed to a tightening bias. So if there would be a rate cut, I don't think it would be something completely unexpected. Would not be unexpected at all. Markets would see the data and then they would infer that a cut could be upcoming as a result of that. So I think due to this easing bias that the Fed is communicating, I think this would not be a problem in terms of preparing the markets for an easing. Of course, a tightening would be something different, but this is not expected. I think a further issue that we should consider, and perhaps we can talk about this in the next months, would be, with the upcoming U.S. presidential election, there's a lot of uncertainty on the trajectory of U.S. monetary policy going into 2025. So, people are talking about the inflationary effects that these policies to be introduced may have, whether it's whichever candidate may win. So I think that we could be entering a world of increased inflation in the US during 2025, which would lead to obviously rate hikes, so reversals of any easing that would take place this year.
Well, we'll definitely talk about that in the coming weeks and months. Once again, thank you very much, John, for joining me this morning.
Thank you, Peter.
That's John Beirne, who is Principal Economist at the Asian Development Bank.
You're listening to Peter Lewis's Money Talk.
Money Talk.
Thank you for listening this morning and for supporting independent, fair and balanced broadcasting in Hong Kong. And please help by subscribing to my daily Asian newsletter. It's completely free of charge, and that's where you'll find more information on some of the topics we've been talking about today. You'll find it at peterlewismoneytalk.substack.com. I'll be back tomorrow when I'll be joined on the show by Andrew Ferris, the CEO of Economist Advisory, and Nick Marrow, lead for global trade at the Economist Intelligence Unit. And with a view from Taiwan is Ross Feingold, who is Director of Research at Cyrus Consulting in Taiwan. See you tomorrow.
Money Talk